Well, thanks for having us. This is, to me, a really interesting panel, right? We're talking about changes in the securitization market post-financial crisis. But that's pretty relevant when you think about the SALT conference and the history of the SALT conference. I remember very clearly Anthony calling our firm and saying, in the crisis, we've got to do something. We've got to rally the industry. I'm going to start this conference. We want you to support us. And that was really the beginning. So I just think it's full circle to come back here and talk about a topic about a structural change in the market and how it's affected an industry and where it's created opportunity, and more importantly, how the professionals are making money with those changes. I'm Peter Tarrant, Managing Director, Partner, BTIG LLC. We're a broker-dealer, started in San Francisco with 5 people in 2002. We're 650 people today. We operate out of 8 countries, 18 cities. We're in a variety of businesses from credit trading to equity trading, prime brokerage, outsourced trading. I personally run a capital introduction team of 10 people that runs a large dating game. We make about 7,000 or 8,000 introductions a year to credit funds, hedge funds, venture funds, and private equity. I'm really, really proud to be with this panel today. It's an incredible group of guys. Collectively, 100 years of investment experience up here on the stage, which I think is really impressive. On an aggregate basis, 4 people managing close to $25 billion in assets for their funds. The least experienced person, which is just by function of age, has been investing for 15 years. And, the oldest is north of 30. So you really couldn't have a better group of guys up here to represent sort of what's happened in the credit markets, what those changes are. But before we go into the panel, I'm just going to have everyone introduce themselves briefly, and then we'll come back and follow a little bit of structure.
Great, thank you. My name is David Rosenblum. I'm a partner at a money management firm called Profit Capital Management. We are based in Austin, Texas, and New York City. And we started out around the time of the financial crisis with $300 million, and given the opportunity set and a lot of the things that we'll be talking about today, over a 10-year period of time, we now manage $2.5 billion. And I like to think of what we do as alternative fixed income or alternative credit. And one of the main reasons you invest with people up here is to invest in things that look like debt that there's no way you could possibly find or get access to on your own.
Greg Richter, partner, PM at Medalist Partners. We are a structured credit, private credit, asset-based lender, about $2.4 billion of AUM, located in New York. We have 30 employees, 17 in New York, focusing on our hedge fund and private credit business. We have 13 folks down at Atlanta with Medalist Partners Corporate Finance, our CLO business. I've been in the business 30 years or so, always focused on securitized product and understanding of the loans and leases that back securities. Recently, we've been building out our private credit business, which is doing more direct lending, but with the same type of assets.
Jack Ross, managing partner and co-founder of Waterfall Asset Management. We've been around for 14 years now, managing over $8 billion in AUM. Our focus is on structured credit, specialty finance, and as well as loans, primarily residential and commercial mortgage loans. We have offices in New York and London, and our most recent venture is actually in the private equity space, investing in specialty finance platforms.
My name is Brett Jefferson. I am the founder and president and co-investment officer of Hildene Capital Management. Hildene just had its 11th anniversary of launching its fund. And we started with my money, which was $2.5 million. We now manage a little less than $10 billion, $3 billion of which is in hedge fund assets. The rest are in CDO contracts that we manage. Our focus is in structured products, opportunistic investing in structured products, and event-driven opportunities that result from structured products. We have about 25 people, and we're headquartered in Stamford, Connecticut.
Okay, great. So look, to make it interesting, we sort of had a few discussions about how we would cover all the variances of change since the financial crisis, the regulations that were put in place, some of the factors that those regulations have created, sort of the evaporation of the prop desk market, and some of the liquidity issues that present themselves as challenges and opportunities. But basically the way we divided it up was all four of the panelists each decided to take a topic. David said he was going to cover and talk about construction lending. Greg was going to talk about U.S. legacy securities and things like aircraft and bridge lending. Jack's going to talk about Europe, an important area where there's been a lot of change. So with that, let's start off with David, who's going to talk about what he's seen in the changes of the regulation post-crisis, and then highlight sort of the opportunities that they're seeing in the construction lending market.
Thanks. So when you think about what happened in the crisis, and you think about the aftermath and what happened with regulation, one of the focus areas, as I think we all know, of post-crisis regulation is the banking system. And there were good things and bad things about that. I think any sort of senior official in the US government or the Fed, the FDIC, and most market participants at large would say the banking system is absolutely safer today than it was then. And I certainly subscribe to that. Many people do, and I think it's true. But the flip side of that has meant that many of the activities that they used to do, they either can't do or are having trouble doing now. For instance, one of the largest loss areas for banks in the crisis was construction loans. So now when the regulator comes to talk to banks about what their bank balance sheet looks like as part of their annual health exam, this is a huge focus. And on top of that, there were actual regulations that were added, one of which was called the Hvcre, or High Volatility Commercial Real Estate Loan Rule, which literally says that if a bank makes a loan and the developer has not put in enough equity, that the bank will be very penalized. So the bank could make the same 50% loan-to-cost loan to a developer that's put up 40 points of equity and be fine. But the same 50 LTC loan that was made to a developer that puts up 20 points of equity may be a problem, even though the bank is lending at the exact same attachment point.
So what do they do in that case when they can't go back to that traditional source?
Well, you have a world that has become a world of the haves and the have-nots. So big developers don't have a problem, but people that are developing $100 million projects or $50 million projects instead of billion-dollar projects need to figure out a way to fill the hole. And you used to fill the hole with a mezz loan, and everyone was happy. You put up 50 points from the bank, the developer puts up 25 points, and a mezz loan comes in for the other 25. But there's been a challenge there. So having identified that challenge, we've basically made it our business to bring a financing solution to this middle market developer and say, we'll lend you the full 75 cents on the dollar. Let us take care of going and finding a bank for the project. They'll lend the money to us instead of lending the money to you. Now you can get your money. The bank can put out the loan. It wants to put out the loan. It just doesn't want to have its regulator tell them they're going to downgrade their financial health for having made it. And the bank gets the comfort of us sitting in the middle. And what do we have to do that? We have to start looking more like a bank.
Right.
We have to figure out a way to put out draws, to do analysis on the construction project, to do monthly analysis on how the project is going, to figure out how to make sure the right insurance is on the property and the project with an insurance consultant, to make sure all the environmental is being done. All these things that a bank department used to do, we've gone in and built so that we could provide, if you will, this service to sit in the middle of the wall and the wallpaper, to facilitate bank capital getting put out to developers, and to facilitate developers having enough capital to be able to develop their middle market project.
That's interesting. Greg, how about you? What are you seeing in the traditional and U.S. lending markets, especially like the aircraft space and the bridge loans?
Sure. Real quickly, post-financial crisis, it took 2-3 years for Dodd-Frank to be implemented. It took a while for banks to adjust to the new regulations. The balance sheet effect of those regulations is still in process now. So when you look at the opportunities that we're looking at, we're trying to target specific areas that are reaping the benefits of a contraction of balance sheet and really risk appetite within the banking system. Away from the banking system, GE Capital, the specialty finance world, is essentially gone, and it's funds like ours collectively that are taking advantage of the spread lending environment, whether it's through securities or debt facilities. I think that a sort of law of unintended consequences, the credit culture within a lot of banking institutions right now has got an incentive not to take on risk, not to put balance sheet to work, and that really benefits a lot of the businesses that we're involved with. When you look at one area where we've been active recently, it's in small balance commercial real estate lending and also bridge and transition lending. So these are areas that have historically been controlled by the banks and finance companies for various reasons. They've opened the door, and from a volume standpoint, oftentimes we're able to originate volume because we're quicker in making decisions, and we're able to get very attractive rates. So bridge, we've got an active program. It's a 65% loan to value max for us. So in the past, the banks would have gone much higher in LTV and taken that risk. Today, they won't even touch a non-stabilized commercial real estate property. So conservative underwriting, and I think that's one sort of blanket statement. Post-financial crisis, a lot of the asset classes that we're active in and touching today are still underwritten with conservative assumptions. There's very few asset classes today that are volume driven. They're focused on credit, and we are funding a lot of those loans or purchasing those loans that have had very conservative underwriting.
Can you talk for a second about something sort of niche-y like aircraft?
Sure.
Where on my side, we've looked at a helicopter leasing company recently, or we've talked to another fund that's providing financing for private jets in difficult geographies like Nigeria and other troubled countries. And then you've got issues like Boeing and the 737 MAX. Like, it's not a riskless trade, but it's also sort of like a poster child for these illiquid credit opportunities.
Sure.
And why people are in them.
So we're not going to touch anything out of Nigeria, not yet. But the aircraft business used to be controlled by banks. So massive Japanese banks, European banks, US banks, they were the primary lenders within that space, and they've all been pulling back. The percentage of aircraft that are now being acquired and owned by leasing companies has grown to over 40%. Leasing companies rely on securitization to fund their business. So again, our world, structured credit, securitized products, is taking on a greater and greater percentage of those fundings. And it's a huge market. The amount of aircraft that get funded every year is in the tens of billions of dollars. So where we're playing is on the front end, warehousing the assets for securitization. So we're giving folks money to basically, with a decent haircut, with a decent amount of over-collateralization to protect us during the aggregation period, and then we're participating in the debt once it's been securitized, both BBB, BB with some leverage. We're getting low double-digit returns, and on the equity front, which tends to be it's pretty thick equity in these deals, 20 to 25%, getting yields between 17 and 19%, structurally levered, not financially levered.
Right, wow. Okay, Jack, how about you? Obviously, Europe's a big topic. A lot of change there. Brexit, no Brexit, hard Brexit, delayed Brexit. How is that, in the context of, post-crisis, regulation, change, and sort of the evolution of Waterfall? What are you guys seeing in Europe? What are you doing? And what has been the recent changes?
Yeah, so the regulation of the banks in Europe is the same as the regulation of the US banks in terms of Basel III, risk-based capital, supplemental leverage ratios. However, the implementation has been much slower. The European banks are probably 3 to 5 years behind the US banks in terms of coming out of the crisis, recapitalizing, taking the pain of their non-performing assets. Today, there's about 700 billion euro of non-performing loans on the balance sheets of European banks. Primarily, at this point, it's in Southern Europe, Italy, France, Spain, Greece, Portugal, where those loans reside. And if you look at where the loans are marked on the balance sheets of these banks, a lot of them are marked well above where the market is willing to buy the loans. So the banks are stuck between a rock and a hard place, meeting the regulatory capital guidelines, and yet cleaning up the balance sheet is quite challenging. And so where we are today is that there are loan sales going on, but they're much more modest versus where the end objective needs to be, which is to clean up the balance sheet. And the ability to raise capital for these banks is virtually nil. And so what has resulted is that in the lending markets, particularly in the consumer lending markets and the smaller property and smaller business lending markets, the banks have retrenched. And so for us, a real strong opportunity is for us to play on both ends of the spectrum. We're buying non-performing loans in Southern Europe off the balance sheets of the banks. In many cases, we can cherry pick those loans to be in the locations that we want and in the property types that we want because the banks need to sell them at prices near where their reserves are.
Can you talk a little bit about that, Jack? So, you can buy NPLs in Italy, you could buy them in Portugal, you might buy them in Greece. Are there areas you're staying away from? Because I've heard a lot of people say, I love Europe, but not touching Southern Europe, or I'm not touching Italy. How do you guys look at that?
So with all non-performing loans and with all real estate to start with, it's local, local, local. You really have to have boots on the ground that understand the local economies, understand the local property markets in order to value these properties. The property markets have gone down considerably since 2007, and the actual number of sales has been paltry. And so you really need local expertise. And so what we do is we partner with local operators, local real estate operators. We provide the majority of the capital. They work with us to value the properties, come up with the appropriate bid price, and then actually work the loans out once we own them, whether that's property sale or a modification of the loan or what have you. In terms of the loss mitigation, it really depends upon the situation. So we're tourists, generally speaking, of course, since we're based in London, but we bridge that gap through partnerships with local operators and local special servicers.
Great, thanks. Brett, CLO market's obviously huge topic in credit. There's been a lot of growth there. There's been a lot of allocations there. I think a lot of people have asked, how long can it go? And I think a lot of people don't understand the market. Can you talk a little bit about Hildene and CLOs, and in the context of the crisis, regulation, how you've capitalized on it, and see opportunity there?
Sure. Well, Hildene's an opportunistic investor. We're not going out and just buying everything that's in the new issue market. So we're trying to take advantage of mispriced options. And probably one of the biggest thing that has happened is that the CLO market has grown, but the involvement of the dealer community has shrunk. When you got to 2006 to 2008, the largest players in the market were the prop desks and the dealers. And that has changed because dealers have no incentive to buy these products. But I think more importantly is besides being a liquidity provider, it's figuring out how to find the mispriced options because of the technical elements that will occur. A good example of that happened, in the fall of last year when the underlying leveraged loan market had extreme amounts of volatility. And a lot of that was driven by the ETF market, which is only 15% of the leveraged loan market. With that happening, that created a sell-off in the loan market and the opportunity to come in and actually buy certain pieces because of dealers couldn't hold that or people looking to get out of it. I think where we also look to position ourselves is that in the new issue market, many people who are issuers cannot get the warehouse financing and need to show up with the equity sold before they can do that. So we can come in and negotiate very, very good terms to be part of the warehouse, terms on what goes into the warehouse, and then be buying equity at a discount and partnering with these managers going forward. So it's a different way of playing in that market. I think as important as being a liquidity provider, it's also being a liquidity creator. We own many assets that are backed by small financial institutions, and they're long dated. And many of them have had a great run up, and they've gotten to a point where it just doesn't make sense for the insurance company, who buys usually the senior parts of these securitizations, to actually partake in it. But what we're doing now is we're creating a re-REMIC of these securitizations, where we're taking, we'll give you an example, $140 million of this asset that we own that doesn't have an investment grade rating, putting it into a trust and issuing 80% out of this trust, which has an investment grade rating, and we're actually tailoring it exactly to the buyer. So instead of going through the bid offer, we're actually getting a premium to what we would get because we're creating this financing that insurance companies want and enabling us to create good financing for the assets that we hold, which also gives us optionality going forward in the event that this financing gets tighter going on an ongoing basis. So as important as it is to be a liquidity provider, it's also important to be a liquidity creator in different ways, in working with who are the buyers to create these products for them.
Great. You know, one of the reasons why I was really excited to do this panel, besides the fact that everyone on it has incredible experience and has done an amazing job building pretty big firms, is we talk to about 800 investors a year. We sit down face to face. And so we have a pretty good sense all the time about where people are pivoting to, where there's interest. I care about Europe, or I care about Latin America. I want Brazil, not Argentina. I'm looking at emerging markets. But one thing that we're hearing a lot more of is people that for years haven't really had demand for credit or distressed credit. And that's coming up a lot more now. And so I was really excited to run this panel, be on this panel with such important players, because for me, if I had money and I was going to buy credit, I wouldn't be buying a huge credit. I'm not buying PIMCO. I want to play in the space where there's inefficiency, you're relatively small, but you need to be at some level of scale where you have an edge, you know who you are, and you can prove to the investor that, hey, there's a reason you want to invest in my fund. So I just wanted to go around the horn and ask everybody, starting with David, you know, if an endowment came to you, if a sovereign came to you, if a family office came to you, you know, why, if they're pivoting to credit, should they give you money?
So when you look at financial markets today as a general rule, and credit markets are no exception, and you play in generic products, you find a situation where the amount of risk you take versus the reward you get is historically rather paltry. But if you look at structured credit and structured finance markets, there are alternatives to that. And interestingly, those alternatives are very underinvested by the global investment community because they sound different, or they have weird names, or it's just a lot easier to feel comfortable keeping your job if you invest in things that everyone understands. And for instance, if you take the CLO market, this is not a backwater. It's a $600 billion market. And the financing system cannot exist without it. And it is the mechanism post-crisis with regulation that enables banks to lend. They can't make the entire loan, but if someone else takes the first 25 points of risk, they can make that loan. Well, guess what? Someone's got to provide the service of taking the 25 points of risk so that the banks can put out their balance sheet. And that's where these types of funds come in. And the amount of compensation you can get for providing that service is much higher for similar levels of risk than you can get in the regular credit markets. You can buy a high yield bond that's double B rated at 7%, You can buy a CLO security that's BB rated at 10%. And we think the BB bond is much safer. It's backed by 125 credits, not 1 credit. When I talked about the construction loan, it's the same thing. I can make a loan at 10%, but if it's a big product with a well-heeled sponsor, it's only 6%. So it's almost like you don't need to look far, but you have to have a little bit of courage. And these markets aren't necessarily tiny. The construction lending business for us is much smaller than the CLO business. But the CLO business alone, whether you apply expertise that Brett has to find the very best BB CLO or not, is still attractive just on an aggregate basis.
Great, great.
Yeah, I'll echo David in the sense of the beta. We have great risk-adjusted returns. We spoke about conservative credit. We spoke about lack of funding. Spoke about, or not really, the inefficient and fragmented nature of our secondary market. All reasons to invest within it. On the alpha side, what we do at Medalist Partners is we have a very diversified approach to our portfolio. So we do a lot of resi, we do a lot of commercial real estate, we do aircraft, we do private student loans. We'll migrate in and out of these sectors depending upon our view of future returns. We have 15 to 20% monthly turnover, so it's an active portfolio approach, and we're good guys.
How about you, Jack?
Yeah, I think when investors look at our strategy or structured credit, broadly speaking, within their opportunistic credit bucket, they compare us all the time to leverage loans and high yield bonds. And so first of all, the correlation of the performance is quite muted between structured credit and high yield and leverage loans. And the primary reason for that is these are cash-on-cash investments. Every quarter, every month, we get cash from these investments, and that's really what's driving the return profile. Where on a corporate bond, every 6 months you get a coupon, and hopefully at the end of 5 years you get paid back your principal. So that is an important driver of performance. It mutes the volatility of the performance, and so investors like that profile, and the correlation to high yield credit is around 0.5, so quite limited. So it's beneficial to marry the structured credit with corporate credit, in the fixed income opportunistic part of the portfolio. And also for our firm, we really reside in the realm of what I like to call legal inside information. And I think the commercial real estate market is a great example of that, where we are buying CMBS bonds, we're making loans to owners of real estate, we're buying distressed loans, we're buying distressed properties inside of our firm. And so all the commercial real estate knowledge that comes to our firm from all this activity is utilized throughout the platform and really benefits us, whether we're playing in the bonds, the loans, or properties.
That's great. Brett, I remember when your fund was just $300 million. So, I want to save at least a minute for questions. But if in 40 seconds, what was your pitch? It was obviously effective. Why are people putting money to work with Hildene? What is it that you're telling them?
Well, I think simplistically is that, when somebody comes into our office, I can help them understand exactly how structured products work by explaining 3 things, which is the value of the assets, the value of the structure, and the value of the option, how you actually break it. And then we break it down and show them the opportunities that they are. I think if I could say the thing that we're most excited about is that we've won a reinsurance company that does life and annuity business a year ago in bankruptcy court. It hasn't closed yet. It might not. But if it does, it gives us a phenomenal platform. And if you think about Warren Buffett, he is a great investor, but he actually has some of the greatest financing there is. And that is a platform which I think will help differentiate us going forward if we can close on it. But I don't know.
That's great. Perfect answer. We have time for 1 or 2 questions. Is there anyone out there that has a question that they'd like to ask the panel? I don't see any arms. I think there's general paralyzation out there. All right, just for our last 20 seconds, Jack, I think you said you were reading the book about China.
Nope.
No, that's
David.
me.
David, tell us why you're reading that book, because I like that answer.
Well, we hear a lot about China these days, and what with most of us being Americans or Westerners, we tend to put on a big blinder when it comes to the other half of the world. And the interesting thing about this book, which is called The Party by Richard McGregor, is that you would think it would have been called The Communist Party, but it's just called The Party. And really, the book gives a pretty incredible insight from an investigative reporter, business reporter, who over a 10-year period really made it his business to understand the party, which is simply a one-party political system versus our two-party political
And from a credit perspective, what did you tell me about China as the size of a player in the securitization market?
Well, it was, I think, Jack that had the
It's the second largest in the world.
So are we there yet for the on-the-ground opportunity? No. Do we need to understand China to generally understand the world and macro and things that are going on? Yes. But one day, when Trump arranges it so that we can actually get boots on the ground there, they will need us to figure this stuff out.
All right.
The market is huge.
You guys, thanks. That's an incredible panel. Thanks, everyone, for listening. I wish I had time to share every book with you, so I encourage you to follow up with the panelists, because everybody but me was reading something very interesting and had a great answer for how that book applied to their view on the credit markets and their view on running a business. Thanks for your time, and thank you, panelists, for joining me today.
Thank you, Peter.
Thank you.